Okay, so we're starting off, and I'll probably just go ahead and keep Hayek's quote up as the theme verse for the rest of the series. The curious task of economics is to demonstrate to men how little they really know about what they imagine they can design. That is really the substance, if you will, of much of the critique, the economic critique of socialism. So today we're going to go through what we call the market socialists, how they responded to Mises. And it might seem a little bit like an oxymoron. What is a market socialist? Well, we're going to learn what that means. And in large part, it is kind of a little bit strange that, in fact, the early socialists had to acknowledge the substance of Mises' critique of economic calculation. And effectively, they said maybe we can incorporate some market-like institutions to help us solve this calculation problem. And that's what we're going to outline today is what they said, how they thought that they could deal with the calculation problem. Just where we're going today, we'll quickly review some background that got us here, summarize last lesson's critique from Mises, what that looks like. And then we're going to spend some time going through kind of a technical thing in economics, statics versus dynamics. And what's that all about? And that really does play a role, a significant role in how we think about this problem. And then I'm going to go through just three of the leading market socialists and how they said they could deal with this calculation debate. So that's where we're heading. Just as a reminder, this is kind of a review. From our first lesson, we kind of talked about there are different reasons why people would advocate for socialism. And I have all three kind of on the board that we talked about before. I've got grayed out the last two areas. We'll come back to inequality, but we're focusing today on this rationality of planning issue. That's what the socialists are trying to say is that, in fact, markets are irrational in the way they allocate resources, and we can do this centrally, and we can have a more rational way to plan the overall economic activity. And so in Mises' response, of course, he'd said, well, you can't calculate. And they said, oh, yes, we can, and we can make things a little bit more rational. But just as a reminder, if you saw the second bullet there, Marx's alienation as market coordination leads to waste. That point that we talked about earlier was suggesting that actually the competitive process of having one firm trying to produce one good while another firm is trying to produce the same good, that would necessarily lead to waste. Marx understood that as inherently a disequilibrium process. We don't have this steady state world where things are just super smooth with minor perturbations. Marx intuitively would have agreed with Mises about the nature of what markets were, as there were competitive, rivalrous processes to decide which products should be consumed and which weren't. And in fact, it was the very nature of the disequilibrium process that really represents markets, which led Marx to his criticism of capitalism. That alienation we're talking about is precisely because of the disequilibrium nature. I'm prefacing this now because in the subsequent discussion we're going to find is, interestingly, the socialists that picked up the call against that would instead refer to the market as actually an equilibrium process instead of a disequilibrium process. We'll get more of that in just a moment, but it's important to preface that since we've covered that before. The anarchy of capitalism, I just grabbed a chart off the internet. You could find a million of these, which you could look at. This was from the dot-com bubble of the late 1990s, early 2000s. You can think of even more recent failures of companies where large amounts of resources are squandered in the pursuit of trying to determine what it truly is that markets need to produce. In the dot-com, you probably don't even remember, many of you probably were just maybe a gleam in your mother's eye. In any case, for when some of these pets.com, you don't remember that because it's been long gone. But all this money was wasted. And in the bottom corner, we see $5 trillion in market value was lost in the aftermath of that. We could look today. I know your generation pretty much abhors Facebook, but to those that have it, you may not remember a company called MySpace, which was the big predecessor to that, right? And so which one should have been there, right? Should we have spent the money on MySpace, given it's now went under? Or should we have went directly to Facebook? Or how could we have ever got to Facebook without MySpace? This question remains about how we actually determine what would be produced. But when Marx says that there's a tremendous loss of resources in the competitive process to determine what should be produced, Marx is absolutely right. There's a lot of waste in these things. The market process is going to discover what the true desires of consumers and the economy ought to produce. It's not given to anyone to know. So that we would have to say that there's a good, valid critique. So just in summary, what we said last time, we said that Mises, in a nutshell, says without the private ownership of the means of production, there are no capital markets. And that meant that there would be no place where millions of people could put together their subjective valuations of what the value of a particular piece of equipment ought to be worth. So without those capital markets, without all those people that would get to vote effectively, you'd have no prices of these capital goods. And without prices of the capital goods, there's no indicators, we would say, of relative scarcity. How much do you value this particular piece of capital equipment vis-a-vis this particular capital equipment? It would be purely arbitrary absent a market process, according to Mises, because without those relative scarcity indicators, you couldn't have any economic calculation. How would you decide what a particular production process ought to be? And so his conclusion is, without private property, you could not have rational economic calculation. That, of course, we said, does not mean that you could not have values assigned, right? It just means that those values would not be done considering the values of millions of people in a market. It would be just in an ad hoc basis set by a central planner according to whatever process they had. But under what basis, what rationality to assess what the relative valuations would they have? And that's the substance of his critique. Now, before we go further now, we need to I need to take some pause to talk about economics as a general kind of science, because this is going to get to the heart of some of how the market socialists respond. We have two visions of how the market works, and one would be this equilibrium process. We'll call that kind of a static process, and one would be a disequilibrium or a dynamic process. We had a school of economists beginning with Adam Smith and ending with Marx called the Classical School of Economics, and they were really focused on kind of what were those long-run trends which lead an economy to perform. You all, without even the benefit probably of a formal microeconomics class, understand supply has to equal demand. You've heard that. It's just supply and demand, at least in those terms. And what that means is that, and intuitively you would know that, I mean, we can even think on an individual basis. If there are two people that have produced an item that they want to sell for $1, and there are two people that want to buy that same item for $1, we're in pretty good shape, right? Supply equals demand. But we can imagine if somebody wants to produce something at one price and people only want to consume at another price, there's this mismatch, there's a sort of a problem there. And what the classical schools suggested was that these would tend to operate in the long term. You're going to tend to see supply have to equal demand in the long term. Well, what happened is we came with a neoclassical revolution, and the neoclassical revolution basically introduced and killed this idea of a labor theory of value, an objective standard of value, and said no, value is really dependent upon the subjective valuations of people that want to consume a good or service and use that. It's our individual desires that we have. And so they came up with models, to very simplified, abstract models to describe how the world would work. But it was just that, a model. a simplified representation of reality. And we would start with this idea that the world would be in equilibrium, all would be in good shape. And supply would be equal to demand in these simplified models, and we could begin asking, what would happen if we relaxed that assumption? And what if we changed one thing? And in that model, we would see, okay, if we start at equilibrium where supply equals demand, and we move one thing, how will we get back to the spot where supply equals demand? And that's, in economics, we call that a comparative static kind of thing. We change one variable, it gets back, but it's a simplified model of reality. A contrasting way to view this would be to look at a disequilibrium approach, or what we might call a market process. And in a market process world, supply never equals demand, ever. There's a tendency towards supply equaling demand, but there's always a process of people making adjustments to try to get ahead of the game. And that actually is a much better descriptor of what economic activity is. I happen to have the privilege of being a dean of a business school. And in addition to teaching economics, I have people that take business specializations, and even engineers across the street will be working for some of those firms. Every one of those students will be thinking, once they graduate and get involved with a company, will be trying to figure out a better way to do something. So if we want to think about supply as the output of goods and services, no one takes that as a given. Every day people get up and go to work precisely to make better processes, to make things cheaper, to make things that will satisfy consumers more. And if they were so slothful not to pursue that vision, they would be destroyed by the competitive force of the markets, because somebody else would. So producers are never sitting on their laurels waiting. And in fact, remember, that's exactly what Marx was critiquing when he highlighted this anarchic mode of production. That's kind of what happens. And in the same way, there are people that are trying to cultivate demand nonstop. And you probably have had that happen. Every day, you'll be exposed to certain communications by advertisers that want to get you to buy something. And I can remember one time I go into Wendy's. I used to go to Wendy's. I'm now a hamburger snob and won't go into Wendy's. Actually, I would, but I don't nowadays too much. But when I was younger, I would go in there. And one day I'm heading into Wendy's for a hamburger of some sort. And oh, there it was. You know those pictures they put on the walls? Right when you're in the line of the new product? The new product for me was a spicy chicken sandwich. It looked so good, I had to try it. I didn't know I wanted a spicy chicken sandwich. I didn't know that demand was there. But there was somebody there that was trying to create a demand in me that I did not recognize. I bought it, I ate it, it was pretty good. I started buying those occasionally. The point is, there's nonstop action to change whatever the existing equilibrium is. There are the competitive forces to try and satisfy your needs and my needs ahead of time. And so that's kind of this process of disequilibrium. As this process would say, I would be more in equilibrium once I ate the chicken sandwich, right? Even though I didn't know before I wasn't in equilibrium with the hamburger, I would have eaten that hamburger fat, dumb, and happy, and just great. But I didn't know I was missing out. It was a higher level of utility or satisfaction once there was a better product I want. And whatever the product is for you, the same thing happens. We constantly have a competitive process in the market to try to kind of find out what we really want. And that's why we see this evolution. And so I say it up there, it's a difference between understanding why the economy goes awry or how an economy works in the first place. So that goes there. The second bullet we've got here, we've got some assumptions for these smaller models, this neoclassical model, this equilibrium model. In that model, and it's a good model, and that's kind of a point, but it's just a model. It's not reality. In that model, we have to assume we have rational agents. And these rational agents have an information level that's unparalleled. And oftentimes economics is often made fun of because we used to have this term homo economicus. It's the term for this rational economic calculating machine, as if humans are just sitting there subjectively assessing costs and benefits nonstop. But that's what the model kind of suggests, is that we are all unique, we all process and all do exactly the right thing each time, rather than a real model is you and I go and participate in the market and we simply do the best we can. We learn, we buy something. Sometimes, I suspect even some of you have bought something and you've been disappointed by the result of that. And you learn, and you won't do the same thing the next time. That is this process that goes on. But these givens that are part of that include consumer preferences, what we want. It includes production possibilities, how you would produce something. One of the key things that the socialists say is, we're going to assume the best technique. Well, that, of course, assumes away the problem. What is the best technique? How do we discover that best technique to produce and serve others better? That's kind of part of the problem. And so in this world, we have people that are simply optimizers. They're optimizers in a world and we do it. For some of you are poor, unfortunate souls that will have me in higher economic classes. I will provide you with mathematical models which you will have to use higher order math to solve as if that were reality. It's a useful construct to understand conceptually how things go, but it is not reality. But in this world, these math equations that we assume people go through, once you're in that process, things don't change. They can't change. Knowledge doesn't change. But in reality, the real world, the way the economy works, is we are constantly learning. Every second of the day. New information comes on board and you're changing your expectations. Sometimes, many times of the day. One of the interesting facets of economics is that the speed with which new information is processed and enters into economic calculation. You will see stock markets respond within seconds of new information. Within 1 minute, some of the studies show all trading opportunities to arbitrage out new information are already expired. That's how efficiently we process new information. And that's why you see the markets reacting up and down all throughout the day. These things are not fixed, time isn't constant, and new knowledge is being changed. And so these are all facets of the way the real economy works. Now, this neoclassical equilibrium, I'm going to introduce another new term. We're going to solve that problem mathematically because the neoclassical economists understood this. But one of the great economists was named Leon Walras. And Walras posited something that could solve this problem. He posited a fictional, what we've translated as the auctioneer. There are different translations that they offer. But the idea would be as if there would be somebody that would call out prices of any good or service, and each one of you in the room would have to say, I'll buy there, I'll abstain there, and he wouldn't allow you to do it, though, until everybody had their bids and takes, until we could make it such that supply exactly equaled demand. No trades would be allowed until we could figure out exactly how we matched everybody up. And this was a fictional process, but it's a French word, tâtonnement. But the clearest English translation we have is groping. It's this idea that the market process is groping almost as if in the dark towards what the real solution to the supply and demand problem would be. And so it's almost like we're searching for it. But to the extent if this were reality, it would eliminate what we call false trading. This false trading would be trading at disequilibrium prices. This is important because if we traded at disequilibrium prices, then the critique that Marx had offered would be applicable to any process that used this as well. You have to trade at equilibrium prices, or you also could have this anarchy and wasted resources. But if you had such a process to work, if we could perfectly line up and understand what people really wanted to produce and really wanted to buy and exactly line that up, you could avoid conceptually any false trading and any wasted resource. And so the way I sum this up is really, and this is a key problem for economics, and I would go beyond economics. It's a key problem for any complex process. We have to, complexity is too much in economics, it's too much in climate models, all these kinds of things, very complex. So we make models to make the real world that we understand simpler, that we can grab a hold of. But those models are not reality. And the more complex the reality is compared to the model, usually the larger the disagreement we tend to have. We still want to use models. They help us understand reality. They are not reality. And that's kind of some of the problems we have to go for. Okay, let's keep going here. Some implications, that's what I call the statics versus dynamics implications. First of all, time has no significant place, according to Shackle, one of the great economists of the 20th century. And this is important. Uncertainty has no place. So what we see here is all the problems that we see inherent in the market process of the way people discover what consumers really want to do, what these best production processes are going to be. They're all assumed away. There's no uncertainty. We will have risk, but not uncertainty. I'll define that in a moment. But Mises' calculation argument was not talking about equilibrium. It was talking about the dynamic economic activity, the real world. And so market socialists challenged Mises by saying, you have denied the theoretical possibility of socialism, even under static conditions. That was not Mises' claim. Mises would have acknowledged there is no economic calculation problem if you're in a world of equilibrium. So there had been a few earlier economists, even that had written before Mises, Barone and Wieser, and they had looked at this issue earlier and said, look, there's a formal similarity between capitalism and socialism, and all they meant by that was they have the same choice problem. Even under a socialist economy, they're going to have to figure out what to choose, what to produce, and what not. But they doubted very seriously that socialism could actually work. But nevertheless, these writers had suggested there was this formal similarity such that later market socialists say, look, it's already been proven. Everybody acknowledges that socialism kind of could work. But they were setting up this static equilibrium approach, saying, well, as a baseline it could, but that's not the problem that Mises was addressing. So as we look beyond those two, there were really two approaches that were taken to solve this problem. The first was some economists actually thought you could solve these millions and millions of simultaneous equations that one would come up, and remember the equations would be descriptive of all consumer preferences, all production processes, somehow that we can just solve those all at once mathematically and we will know exactly what to do. A much more simple approach, of course, was to just try trial and error, and the market socialists are going to claim that's what markets do. Why can't we just try trial and error? This approach, we would say that could solve, either of these approaches could solve what we could call a computation problem, but not a calculation problem. And that's the rub of the matter. A computation problem says, hey, there's all these variables, there's millions of consumers, there's millions of producers. If we know exactly what the consumers want, if we know what all the production possibilities are, conceptually we could all agree. In fact, even back in the 1920s, they were thinking that there's got to be some sort of calculating machine that could get a handle on this. There's some sort of computer that could start to working. And we can imagine today, for instance, in the modern world, the millions of simultaneous equations, who cares? Easy solved. But that's not the problem. The problem at root is something much deeper, and we call that the calculation problem. And that is precisely, how do you know what the equations are? The equations for consumer preferences, the equations for production processes. And not just that. If you knew what the consumer preference equation was, what are you going to do when I decide I want a spicy chicken sandwich? What happens to that equation? And I'm not alone. You'll be changing something every second of the day. Consumer preferences are changing. Production processes are being competed over. All that dynamic nature describes the problem. Well, we're going to briefly cover 3 market socialists just to kind of hit. The first broadside against Mises, recall that Mises wrote his seminal argument in 1920 in a journal article, later came out with a whole book in 1922 that was benefited or was informed, shall we say, that would be a better way to say it, informed by the socialist experience in Russia and the Bolshevik Revolution and the ongoing collapse of some of the activities after World War I. So it wasn't very long. Fred Taylor, towards the end of the 20s, gave one of the first answers of this to respond to Mises. And it's important, the very first one, notice, he defined socialism. Again, this is kind of that classic view, just to make sure we're aware. When we talk socialism economically, we're talking, should the government control the means of production? Should the government direct all capital allocation towards producing the goods and services that people want? So Taylor posited we can have socialism. We're just going to have some supreme economic authority. They're going to get together and they're going to do the valuations of what this scarce capital could be used for, put kind of its price in there. Its relative importance wouldn't really be a price, but nevertheless, we'll call these factor valuations, and that's going to emerge, he says, from a vast complex of production processes. And so what Taylor is suggesting is, if we look at the existing structure of how things are produced, we can have technical experts see how much of this is valued relative to how much of this, and we can get a comparison just by looking at what we have today. That's effectively how he would suggest we're going to generate these factor valuation tables. And at some level you could do this, and indeed the socialists did indeed do that. We talked earlier, for years as the Soviet Union progressed, they simply used market prices as those indicators of relative scarcity. But for Taylor, we would start there, and then it would emerge. How he would specifically get that, certainly any change, Taylor did not address that. Mises would argue, of course, that those relative valuations could really only be found in money prices. And when Taylor assumes them available, in essence, from a Misesian perspective, we would say he's assuming away the problem. If you assume that all the knowledge and the information is given, you've assumed away the problem. That's not a problem in a static economy. Now, Taylor would also go forward and say, okay, now what would happen? Let's take that as the baseline. We're going to start basically with capitalism. And that's not an unreasonable assumption. Remember, for Marx, the industries are going to get larger and larger, and we're going to have monopolies, and basically we'll transfer control from the monopoly in the capitalist system to the monopoly in the socialist system, basically government replacing that. And so socialism would evolve from capitalism in the existing structure. So now how does Taylor say, well, when we put the factor valuations in, we start allocating resources, if at the end of the day there are any surpluses or deficits in these productive goods, we will know that we need to alter the terms of the prices to adjust. And he assumed that would be a fairly transparent process, and one that would work fairly seamlessly would probably be the right way to say it. But that raises a whole host of questions. How would you avoid false trading in this scenario? If the factor valuation tables are wrong, how does that answer the critique that Marx had said in the first place of disequilibrium? How would you ever ensure you got to equilibrium? And he talked about from a given production period. That ought to raise a question in your mind. What is the production period? How quickly do markets change the production period? What do you think? For an individual company, it's probably, days, weeks, months, who knows? But for an economy, every second there are adjustments being made to this process. And so when we start thinking about a production period, should it be a day, should it be a week? How much false trading have you allowed? Why would one assume under this model, even if you assumed it's possible, that you're necessarily going to have a more efficient use of resources when you start introducing these things? And that posits also an amazing statistical collection process. The supreme economic authority is going to have all this data. How, pray tell? How quickly would they get it? How would it be reported? Those things are not free. I assure you, the Bureau of Labor Statistics, the Bureau of Economic Analysis, we have voluminous economic statistical agencies in America today. Those are not free. They cost us quite a bit. Not saying that's not worth it, but the point is, it's something that does take significant resources. The market, on the other hand, we're going to learn this when we get to Hayek's response next week even. The market, one of the virtues of the market is the economy at which information is transmitted. All we need to see in a market is the price. That price, we don't need to know all these relevant details. We'll get to it. But it's super efficient at communicating the essential information act without extraneous information. Next one up is a guy named H.D. Dickinson. I included him. He wrote in 1933. He's interesting because he actually asserted that the Walrasian model was actually possible. So we're going to have the Supreme Economic Council actually gather the statistics. They're going to construct these Walrasian simultaneous equations. They're then going to solve them. And with the solutions, they're going to give those directions, the solutions, to all the socialist managers that are in charge of each of the plants and factories in the country. That's kind of the model that Dickinson suggested would be possible. And I got a couple quotes up here. He says, most, if not all, of the, quote, ignorance of economic opportunities would be eliminated by the publicity of a planned economic system. So in other words, just by announcing this new system, people would know to do the right thing almost. I'm not sure how that would happen, but nevertheless it's there. And he said it's going to be solved as if all enterprise work, as it were, within glass walls. And what he meant by that is that when we have this system out in place, when the Supreme Economic Authority has published all that data, everybody's going to have visibility into what everybody else does, such nobody's going to make a mistake and produce something that's in conflict with somebody else. Again, that's trying to get rid of the anarchy of production. Now, how reasonable you think that is your assessment. And nevertheless, that's a large challenge. A couple quotes from Mises and Hayek up there about the difficulty of trying to do that. Hayek asserts no one really, and in fact, we'll see next time, Hayek really struggled with this. He couldn't actually believe somebody would say that's a viable way to solve this. We're actually going to solve millions of equations. By 1939, Dickinson had kind of given up on that idea and says there's too much rapidity of change, and so this isn't going to be able to work. The most profound and the one that had the most success was an economist, a brilliant Polish economist named Oskar Lange. And Lange was, he assumed Taylor's work was correct, that we'd saw just a few minutes. He said it needed to be elaborated on key point. Lange had a two-pronged approach. He solved this in two ways. He said, look, there's a static part. Let's just assume all these things are given. Now, there's some problems with that, but he's going to relax that in a moment. We're going to assume that all this decentralized knowledge of production processes, the taste, all these things are given to plant managers. And then, with that given information, we're going to solve the equations. We're going to actually figure out what should be done. So far, so good. But then, and this is what was very clever on his part, he says, we're going to relax this givenness, and we're going to allow a dynamic piece. But here's the key part for Lange. He only relaxed one of the knowledge assumptions, that we had the correct prices. And then he says, if we relax that we don't have the correct prices, we will use trial and error to determine what the correct prices would be. And so, once again, he's effectively introducing what we would call a way to solve this computation problem rather than calculation problem. I'll go more here in a moment. So let's elaborate on his model a little bit more. So he says, if you had what we would call in economic terms a perfectly competitive model, and he was borrowing from the neoclassical economics of the day, and he says, look, there's three pieces of information that we need to solve this problem. First, we need to know what the consumer valuations are. And second, we need to know knowledge of what he calls, quote, terms on which alternatives are offered. What we would think of normally as prices. And then we have to have knowledge of how many are available resources out there, what the production possibilities are. And for 1 and 3, if you look up there, he says, look, the socialists are going to have just as much information on 1 and 3 as do the capitalists. They will have to solve the consumer preference gathering data, but so does the capitalist system. Likewise, he says the capitalist system has to figure out what resources are available. There's no reason to suggest that the socialist system could not do that as well. But what he did then was change it on the second one, this knowledge of terms on which alternatives were offered. That would be in a market system, the price level. But Lange introduced, following an earlier economist, that says, well, really, that's just one way to think about prices. If we think about prices as not relative scarcity indicators, but just as terms on which alternatives are offered, we could effectively let them set, the central planner could set a price, a term on which alternatives are offered. We could see how people behaved in light of those trade-offs, if you will. If there's a surplus or a deficit, we can react and adjust according to that. So for Lange, it's in effect an abstract accounting price. It is not necessarily going to indicate any sort of scarcity information to give rise to real consumer or even producer valuations. And so those terms could be what was reflected by Taylor's factor valuation tables. But he said whatever that would be, it would ultimately be determined by the production functions. And this quote is interesting to me at least. Administrators of a socialist economy will have exactly the same knowledge or the lack of knowledge of the production functions as the capitalist entrepreneurs. And that should give rise for a question to you. Well, how would you critique that? Is that true? A price in a market system would convey a lot more than just some, what he calls terms on which alternatives are offered. That would give information content to tell a real entrepreneur how they should adjust their behavior. And the signal of profit and loss would give a lot more firm guidance to an entrepreneur than would some abstract trade-off that's there. So we'll hit that some more. But continuing further, so he's the model for perfectly competitive markets. Consumers are just going to maximize their utility. They're going to buy consumption purchases that make them feel as good as they can. And producers in his model, in a market system, producers would be maximizing profit. That's the standard assumption we make for production. And he says, well, when they maximize profit, all they really do is produce where price equals the marginal cost. That's technical. You don't need to worry about it too much. Here's what he says. If that's what they do in markets, we will just have the supreme economic authority direct the plant managers to produce where price equals marginal cost. We can have them do the same thing as the market. And so he would allow for consumer prices, even wages, to be determined by the market, but factor prices, the means of production, would be determined by the Central Planning Board. And it's a worthwhile question. If the world looks like a Walrasian auctioneer, why couldn't you replace the Walrasian auctioneer with a central planning board? It's a legitimate question. If the world looks like a Walrasian auctioneer in an equilibrium process, and that's what the economy really is all about. But if it's not, then there's a problem. So Lange assumes that both entrepreneurs and central planners have knowledge to solve, but that knowledge problem is only a temporary ignorance of what the correct prices are. The production function associated cost curves given, there's no such thing as a cost curve. If you were to take my microclass, I would draw it on the board for you. But that's a heuristic. It's a model of thinking. Those cost curves don't exist until entrepreneurs put plans in action. But they would assume those given. Okay, so how would they do it overall? The trial and error process, they would assume that these prices would quickly correct. We've got modern socialists called planimetricians. Planimetricians, you like that? They're planners. They would deny that you would get this quick of an equilibrium that Lange was quick to assert. Hayek, of course, assumed that this was kind of impossible because it's not just that there are so many changes, but every single change that makes necessarily has a whole correspondence of millions of other changes. The adjustments are constantly reinforcing and working towards other goods. Don Lavoie said this trivializes the problem of market change in a realistically complex economy. Okay. Lange goes further and says, look, socialism is actually better than markets. Why would he say that? Well, look, socialism can duplicate the perfectly competitive model, he says. But we know that capitalism is riddled with monopoly. And because we could avoid that problem, socialism is superior. Furthermore, we'll have the rationality of socialism. Markets have these boom-bust, these business cycles. In a socialism, we would have rational central planning such that we would not have that kind of thing happen. And his quote there, and the emphasis is in his original, all the alternatives gained and sacrificed can be taken into account. If you have a problem in an economy, we could consider everything that went wrong before we make the next move. We don't have to have a vicious spiral down in the economy under socialism. That, of course, continues to assume that they're going to have all the knowledge relevant. And if they did have such knowledge, why would they ever allow a hiccup, if you will, in the economy in the first place? In my line, better, stronger, faster, he suggested that the Central Planning Board is going to have such an increase in knowledge that they would actually be able to adjust quicker than a market would be to a disequilibrium process. And he says, we're going to have so much more knowledge, and this is kind of our tie to our book by Soul. Soul suggests that, hey, it depends on what knowledge is. Is knowledge systemic? Is knowledge something that comes from the millions of individuals that add up to a superior result? Or is the knowledge that resides that's articulated by a few? And so a constrained vision would have knowledge as systemic, and market prices would contain much of this knowledge that's embedded from millions of individuals. An unconstrained vision would say, no, that this knowledge is continually growing, and reason and that's articulated rationality would lead us to a better result. So if the central planner was just one person and articulated rationality prevailed, then yeah, they would probably have, with their technical expertise, better data. But if market prices actually have information content from millions and millions of people, then no, a socialist system would not have a superior list of knowledge.